Warren Buffett is one of the richest people in the world, but here's something that might surprise you. He didn't become a billionaire through luck or by chasing the latest trends. Instead, he used a strategy that is simple yet incredibly powerful. Did you know that if you had invested just $1,000 in Berkshire Hathaway back in 1965, it would be worth over $28 million today? That's the kind of power we're talking about. And Buffett didn't do it with tech stocks or high-risk investments. He did it by sticking to the basics, buying good businesses at fair prices and letting time work its magic. In this video, we're diving into the strategies that made Warren Buffett the world's most successful investor. From his secret weapon of compounding to how he carefully picks only the best opportunities, you'll learn exactly how Buffett stays ahead. We'll also explore how patience, emotional control, and understanding intrinsic value have helped him crush the market for decades. Stay tuned because the lessons you'll discover here can completely change the way you approach investing. Ready to find out how to apply Buffett's methods to your own portfolio? Let's get started. Chapter 1. The Magic of Compounding. Buffett's quiet power. Warren Buffett's secret weapon is something simple but powerful: the magic of compounding. The key idea is straightforward: money makes more money over time. Buffett is known for his long-term approach, where his investments grow exponentially because of compounding. In fact, Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." He doesn't rush, he waits for the compounding to work its magic. Let's break it down. Imagine you invest $1,000 in a stock that grows at 10% annually. After 1 year, you'll have $1,100. But here's the trick: that 10% interest is applied to the new total, $1,100, not just the original $1,000. Over time, this growth accelerates. By year 10, your $1,000 would have grown to $2,593, without adding any new money. Buffett's ability to wait is legendary. He believes the best investments often take time to pay off. His investments in companies like Coca-Cola and American Express have delivered returns over decades, thanks to compounding. It's not about getting rich quick, it's about letting the money grow steadily. In fact, Buffett has called his long-term approach a simple idea that works. When he bought Coca-Cola in the late 80s, he didn't plan to sell it anytime soon. Today, that investment has grown over 25 times its original value. That's the power of compounding in action. Chapter 2. The Power of Patience. Why Buffett waits, and you should too. Patience is another critical element in Buffett's investment strategy. It's easy to get excited about the next big thing, but Buffett teaches us to slow down. He once said, "The stock market is designed to transfer money from the active to the patient." This quote sums up his entire approach. Buffett doesn't chase trends. He waits for the right opportunity, the one that fits within his circle of competence and offers true value. He's patient enough to wait years before making a move, which is why he has consistently outperformed the market. In 2008, when the world was in financial turmoil, Buffett swooped in and invested in Goldman Sachs and General Electric. These investments were made when everyone else was afraid. His patience paid off handsomely. It's not about reacting to every market fluctuation, it's about recognizing the right moment to act. Buffett's patience extends beyond his investments. He holds his stocks for the long haul, sometimes decades. In fact, he has said that his favorite holding period is forever. Patience gives him the chance to ride out market ups and downs while letting his investments grow. Statistics support this too. According to a 2020 report by Fidelity, investors who hold onto their stocks for 20 years earn an average of 6.2% per year. Patience isn't just a Buffett principle, it's backed by data. Chapter 3. The Circle of Competence. How Buffett chooses his battles. Buffett's investing strategy revolves around a powerful idea called the circle of competence. This means only investing in businesses you understand thoroughly. In his own words, "We don't invest in anything we don't understand." This approach helps reduce risk. It's about focusing on what you know and avoiding areas where you're less sure. Buffett doesn't invest in tech companies or industries he doesn't fully grasp. Instead, he sticks to what he calls simple, understandable businesses, like insurance, retail, and food. For example, Buffett's decision to invest in See's Candies wasn't based on cutting-edge tech or flashy new trends. Instead, it was based on the company's simple business model, selling candy that people love. He understood it inside and out, and that understanding gave him the confidence to invest. Having a circle of competence means knowing your limits. It's not about being an expert in everything, it's about being smart enough to admit when you don't know enough. Buffett's wisdom lies in knowing exactly when to step back and leave certain investments alone. In fact, research shows that people tend to perform better in areas they understand. A 2017 study by CFA Institute showed that investors who stuck to familiar sectors outperformed those who ventured too far beyond their knowledge. If you're enjoying these tips, don't forget to hit the subscribe button. That way, you'll get more insights like this in future videos. Chapter 4. The Intrinsic Value Equation. Decoding Buffett's valuation formula. Buffett's key to investing is figuring out the true value of a company, its intrinsic value. He looks beyond the price tag of a stock and asks, what's this business worth? To calculate intrinsic value, Buffett focuses on the company's future cash flow, its profitability, and its growth potential. He's famously avoided overpaying for stocks. Buffett's formula for calculating intrinsic value is simple. Value is what you get, price is what you pay. He believes that buying below intrinsic value offers a margin of safety, protecting the investor from the downside. One example of this is his investment in Apple. While many were skeptical about the tech giant in its early years, Buffett calculated that its future cash flow would more than justify the price. Today, Apple is one of Berkshire Hathaway's largest holdings, demonstrating the success of Buffett's value investing formula. Buffett's use of intrinsic value is a key reason why he doesn't get swayed by market noise. Instead of chasing stock prices, he looks for companies whose intrinsic value is far greater than their market price. In essence, he buys value, not hype. This approach works. According to data from the S&P 500, companies with strong fundamentals and undervalued stocks have historically outperformed the market over the long term. Chapter 5. The secret behind Buffett's fat pitch philosophy. Buffett is known for being picky with his investments. He doesn't just buy anything, he waits for the perfect opportunity. This is what he calls the fat pitch philosophy. In baseball, a fat pitch is one that's easy to hit. In investing, it's a great opportunity that's hard to pass up. Buffett's approach is about being selective and waiting for a company to come along that meets all his criteria, undervalued, with strong growth potential and a competitive advantage. He doesn't swing at every stock, he waits for the one that's just right. This selective strategy helped him make some of his best investments, like his purchase of American Express in the 1960s. The company was undervalued and faced a crisis, but Buffett saw the long-term potential. His patience paid off, as American Express went on to deliver massive returns. This philosophy also helped him avoid the dot-com bubble in the late 90s. While others rushed to invest in tech stocks, Buffett stayed out. He knew that most of these companies didn't have strong fundamentals. By avoiding the hype, he saved himself from huge losses. Statistics back up Buffett's approach. According to a study by the National Bureau of Economic Research, companies that are selected based on solid fundamentals outperform those picked based on trends. Chapter 6. Behavioral Mastery. Buffett's edge over the crowd. Warren Buffett's true edge might not come from his ability to read financial statements or understand markets, but from his exceptional control over his emotions. Unlike many investors, Buffett doesn't let fear or greed guide his decisions. He knows that the market is driven by emotions, and he doesn't let them affect his strategy. In fact, Buffett once said, "The stock market is a device for transferring money from the active to the patient." He's known for his calm demeanor and ability to avoid the emotional rollercoaster that most investors experience. Behavioral finance studies show that emotions like fear and greed often lead to poor investment decisions. Investors panic during downturns and chase after hot stocks during rallies. Buffett, on the other hand, remains unshaken by market fluctuations, and this mental discipline gives him an edge over others. For example, during the 2008 financial crisis, Buffett was buying while others were selling. His ability to remain calm during times of panic allowed him to take advantage of undervalued stocks. Research shows that investors who manage their emotions tend to outperform those who are driven by short-term impulses. A 2014 study by Vanguard found that investor behavior could have a greater impact on returns than the choice of investment itself. Don't forget to subscribe for more of these incredible investing insights. Stick around for future videos that dive even deeper into the strategies of legendary investors like Warren Buffett.